Alright guys, so I feel like I wanted to make this video forever, but I'm gonna take a look at the Fed balance sheets here. Now, I know there's more recent ones, but I couldn't find it at the moment. But for this time being though, it's just one line item that I want to kind of show you what I mean in this video. But before I do that, I like to say that I'm not a financial advisor. I don't have any credential in the economy and anything like that. Just random person in on the YouTube over here. Uh, try to understand the market here. Now, let's see. So, in this website that I found, that is called Trading Economics, and that's pretty useful information here. So, if you want to check the website out, go ahead and do that. I'll leave the link down below. Now one line item that I want to kind of look into is the currency, right? So this is just the dollar pricing in the world market, right? Compared to others, and you could see kind of look at the forecast, right? It's forecasting that it's going to become more expensive, meaning that the equity, which is the stock market, going to come down with it as well. Now, why are they doing that? Well, why is the dollar going to go up? Because of the rates. We don't know what the Fed's going to do next month. We just know that from what has been said by the chairman, Jerome Powell, he often said that he's going to continue to raise rate until the job is done. And the job for him is clearly defined by him and by Congress, is to keep it at 2%. Now he always said like, hey, this is not a line item that we, will hit all the time, but we'll stay close to 2%. Okay. And, it's not a guarantee, right? So it just gives you the confidence that, that we should have in the market. But again, like, every decision that they make, it's only for the top 1%. It's not really to look out for the, the people who are actually struggling due to high inflation, right? And high inflation is always going to hit the lower class and the middle class much harder than the top one, right? As long as they keep the rate low for businesses and all that stuff, it's going to elicit a lot of companies that are called zombie company, right? Without the cheap money, they cannot survive. And this is the economic crisis that we're getting in, because money has been cheap for these people for a long time, and they don't know how to operate without those cheap money. So the companies that you're seeing, the S&P 500, might drop down drastically, because if you look at any company like AT&T and all that stuff, they are all in debt up to their eyeball. So I don't know how their profit margin's gonna look like this coming years, and the fact that the inflation is gonna eat up the consumer base economy, right? And on top of that, because the U.S. economy is based on consumption, high consumption, it's gonna hit us harder than anyone else, right? Now, we oftentimes compare the U.S. inflation to the other country, right? Yes, compared to other country, we're kind of in the mid, like we're not too bad, we're not too good either, right? And I think the only reason why we're better off than European, for example, is because we have the status of world reserve currency. Is that the other country needs dollar in order to settle their debt. And so if they borrow money in dollar terms, they have to, devalue their own currency in order to pay, their debt in US dollar. So, now I don't know if I mentioned this already, but if not, I'll just mention it here. So the concerning part is the fact that the interest rate Fed rate hike is actually slower than the actual inflation here. And keep in mind, they have been 2 years late into raising rate. Remember, when Jay Powell or Janet Yellen has been saying that, oh, inflation's not going to sit very high, it's just due to the supply chain, it's a transitory, and they've been saying that for 2 years, right? And now that the inflation has been high for 2 years, they're changing their tune. They're like, oh, inflation's going to be bad, and da 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 da, right? It's 2 years too late. So this is why you see the price hike is higher than the actual inflation that is being reported. Um, so the fact that they are raising rate, that is great, but it's not fast enough to keep up with it. Now, if you look at this, the forecast is going to be inflation is going to drop down a lot lower right here, and they are forecasting that, okay, by quarter 4 we're going to see 2%. I wouldn't be betting on that, because the fact that they're too late to the game, and the fact that this rate hike is only going to take effect 6 months from now, because as you raise the rate, it's it's gonna affect the economy, not immediately, right? So we have to, I think, at least 1 quarter or 2 quarters in order to see the effect of the rate hike here, however slow it is, right? Now, the line items that I'm concerning about as a GME investor is this right here, and I think I make a video about that, predicting the earnings of GME for fourth quarter, right? And this is the number that was reported month to month, that were down 1.1% in retail sale. Now, that may not seem that much, like 1%, right? It's a big deal. Well, when you account for trillions of dollars, that's pretty big deals. And then consumer confidence is projected to be a lot lower coming years. Now, the fact that the sale is down, I'm not really, concerned about that. I'm concerned about the operation costs for GME, right? And, I'm hoping that they will be able to cut more and more as time goes on. And I'm sure, if they absolutely have to, I feel like they will cut down more this coming 2 quarters. This is just a projected number, right? Like, usually quarter 1, quarter 2 is the slowest, right? For retail. It will start to pick up in the middle of the year. It's a cycle, right? So by fourth quarter of this year, they seem to think that it's going to be a lot better for retail base businesses, right? All right. And then what else I'm gonna take a look at? Actually, I'm gonna do the consumer housing. I think housing is the one, no? Consumer debt, total debt, right here. All right. Now, this is the one that's kind of concerning for the economy, right? Usually when they said, oh, consumers spending more money, well, why are they spending more money? Well, because number one, inflation is high, right? And number two, they still have money to spend because they load on more debt, like the credit card debt, for example. Look at it, previous and last, meaning that it's increasing quarter to quarter, right? And since it's in trillions, that means let me see, about $400 billion added to the debt of a consumer. That's terrible, right? Because when you load on debt, that means you have to pay interest on those, and it just put a lot more risk into the system, right? Car loan is enormous. Jump up to $1.5 trillion. That's terrible for some reason, like why it's so high. Now, the other debt that is kind of like it's been high for a long time, right? It's $11 trillion, close to $12 trillion. That's a lot, you guys, a lot. Cause for concern, why? Here's why. I think the reason why the housing market has not tanked yet is because the Federal Reserve is propping it up. Mortgage-backed security, and the fact that it's in an asset item, that's concerning as well. So if you look at this, it's $2.7 trillion in mortgage-backed security, which is up almost $100 billion up from the last 9 months, right? According to this number right here. So it is concerning. Why? Why is it in the asset item? Well, it is a derivative. This is a derivative because it hinges on the fact that people will pay mortgage day after day or month after month, right? If people don't have money to pay off those mortgage, the US government or the Federal Reserve is going to be in trouble because without those mortgage-backed security as an asset, or the housing market is dropping down in price because nobody will have the money to buy the house anymore because everything is just expensive, too expensive for everybody to own a house, right? And so when the price of the house crash, that means lower and lower, less amount of people would be able to afford the home, afford the mortgage, bankruptcy, right? So when the underlying asset price goes up, the derivative also, when the underlying asset goes down, then the derivative also goes down with it as well. That's why it's so dangerous. Now, the other line item that I want to point out is the repo market, right? Of course, we've been, like, whoever been tracking repo market is familiar with this already, but it's in the tune of $2.7 trillion. This is insane, you guys. Why is it insane? Well, because you are actually paying the interest on this. Look at this. $2.4 billion for the last 9 months. It's unsustainable to say the least, right? It's pretty easy to see why the housing market is exploding because it's being propped up, right? So, but anyway, so I'm expecting it to come down in the next 2 years here because, again, nobody has any money to afford anything anymore. Everything just so expensive. Housing wage doesn't keep up. Yes, people would like to, say, oh, wage is going to be higher and people are going to be able to buy more, but it's not keeping up with the inflation. That's what I'm trying to say. So unless you get double the amount of money that you got 2 years ago, you'll be in the hole actually. So alright guys, so that's all I have for this video. Hopefully my audios would be a lot better. And have a nice day. Bye.